Hello everyone, welcome to our Egyptian online seminar group. First, resolve the any questions you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming here Professor Oliver Binz. Oliver Binz is an assistant professor of accounting at the European School of Management and Technology. His interest lie at the intersection of equity valuations, macroeconomics, and economic history. Some of his recent projects explore how macroeconomics developments affect manager and consumer decision making and the resulting consequences of corporate investment efficiency and profits. His research has been published in top-ranking journals, including the Journal of Accounting Research and Journal of Accounting and Economics and the Accounting Review. Now we will start our seminar with dear Professor Oliver Binz.
Thank you very much, Mohamed, for the kind introduction and the invitation to speak here. And thanks to all of you, of course, for making the time to come here. This is a project with Martin, who's also in the audience, and we are now in the process of collecting feedback, shaping it up until we submit it to an accounting journal for the first time. And so we very much appreciate you taking the time here and providing us with feedback. So if at any point you have anything, please just interrupt me, just stop me, or, of course, if you're more comfortable with that, ask after the presentation. We're really very glad for any questions and suggestions you might have. And Martin is also in the audience, so he's taking notes so that we can be as efficient as possible, so that we hopefully make this a great and productive experience for everyone involved. All right, so what is the paper about? The title kind of indicates it. The paper is about the fourth quarter earnings effect, and let me just get right into it to kind of show you what it is. What we've done here is we just plotted average earnings essentially over time, but we haven't done it on an annual basis, but on a quarterly basis. So rather than just plotting for the fiscal year, we plotted it for every fiscal quarter, also within the fiscal year. And when we did that, one thing stood kind of out, and that is what you can see here in the red dots. And that is that in the fourth quarter, earnings are on average like quite a bit lower, right? Nearly, if you take an average, nearly 50% lower. And that is very systematic, right? So you see these downward spikes really every single fourth quarter before it bounces up again for the first quarter and then stays elevated, and then the next fourth quarter it goes down again, right? So this is essentially the pattern that we're interested in this paper. The first thing, of course, that we were thinking about is that it might just be seasonality, right? So that essentially it could be that in certain times of the year there's just a lot of sales activity going on, and that we're just capturing some sort of real temporal seasonality here by looking at fiscal quarters, but that doesn't seem to be it. So what we see here is that same plot, but controlling for year-month fixed effects, essentially. Industry year-month fixed effects. So here we are now really looking at the fourth quarter effect just within a certain industry year, right? So really trying to hold this economic environment constant here. And if anything, we see that the effect becomes quite a bit more pronounced, right? So you see these large downward spikes every single fourth quarter. And this is something that, to the best of our knowledge, really hasn't been documented yet. So we were interested in exploring it more. And how did we start? Well, we started to decompose the effect to try to make sense of what's going on. The first thing we did is, well, we looked at it across the entire earnings distribution. So not just like at average earnings, but like at all the different percentiles of earnings. And that's what we plotted here. And as you would imagine, well, the more we go to the left-hand tail of the distribution, the more negative the effect gets. That's not so surprising. But what is, I think, kind of interesting here is that the effect is negative throughout basically the entire distributions for which we could, for the entire distribution for which we could run quantile regressions here, right? So even here for the 90th percentile, that's the last quantile we could do it for, we see that it's still negative and highly significant. The next decomposition we were thinking about is, well, where's it coming from? Is that revenue thing, right? So if you think about what is earnings, well, it's essentially just revenues minus expenses. So we could decompose earnings into revenues minus individual expense accounts. This is what you see here. So, well, when we look at sales, so revenues first, we actually see that the fourth quarter effect for sales is positive. Sales tend to be higher in the fourth quarter, which might be aligned with certain business seasonalities or anything. But importantly, this works actually against this negative fourth quarter earnings effect that we have been observing in the previous charts. So what is driving it then? Well, that becomes very clear when we look at the additional columns in this table, in particular cost of goods sold, SG&A, depreciation, and special items. We see that they are also quite a bit higher in the fourth quarter. In particular, cost of goods sold and SG&A, who seem to be really driving this entire effect, right? So when we look at this year, sales in the fourth quarter tend to be around 1.1% of total assets higher in the fourth quarter, but cost of goods sold tends to be around 2.4% of total assets higher. That is already then completely offsetting this positive sales effect. So we then kept on digging deeper, right, decomposing further. So we now know, okay, this is not driven by sales, this is entirely driven by expenses. But then which expenses, right? And what we are doing here is now we first kind of look at, let's say, real cash effects, right? So we look at CFO relative to just accrual effects, right? So what is essentially what accrual accounting does, right? So there are different types of accruals. Well, there are changes in working capital and accounting estimates, right? So, and when we then break it down, we see that the cash fourth quarter effect is actually again positive, right? So just what we had observed for sales, right? So cash flow from operations tends to be actually higher in the fourth quarter. Again, this might be aligned with certain business seasonality effects, maybe, but it's counteracting the main negative effect we observe when we look at overall earnings. So where is it coming from then? Well, it's entirely coming from accruals, right? So as you can see here, again, the cash effect is completely and more than offset by accruals. And if you then split accruals into working capital and accounting estimates, you see that it's present for both changes in working capital as well as accounting estimates, but quite a bit stronger for accounting estimates. So just in terms of economic magnitude here, we see that the earnings component deriving from accounting estimates falls by around 4.4% of total assets in the fourth quarter relative to the first quarter, whereas we do not see similar effects for the second and third quarter. We then also looked at specific accrual expense estimates, right? So everything right now is pointing towards accrual expense estimates. And here we then went to XBRL to collect specific accrual expense accounting data directly disclosed by firms. And we looked at three relatively common accrual expense estimates. That is bad debt expense, warranty expense, and inventory impairments. And again, when we compare these effects to the other quarters, the effect is much, much higher. Again, we see that these expenses, these accrual expense estimates tend to be much, much higher in the fourth quarter relative to other quarters. The last thing we did on the part of the exploratory analysis is we wanted to understand, is that something that happens throughout the entire distribution of companies? In particular, we were interested in looking at size, given that larger companies tend to be more under public scrutiny than smaller companies. So we wanted to understand whether this is something that might derive from, let's say, more or less capital market pressure. And what I show you here is first the sales effect again, right? So we're just positive throughout, but where we do not see much of a size variation, like it seems to be relatively stable across the entire size distribution. But what we see in the orange line is the fourth quarter effect for earnings. And there we see that it's extremely negative, it's negative throughout, but that it's extremely pronounced when we go to the smaller firms, right? So here, again, what to take away from this plot, the fourth quarter effect seems to be really concentrated in smaller firms for the fourth quarter rather than, and there's nothing like that for sales. We did that same plot for all the other analysis that I've shown you before. So first here looking at expenses, right? So we see again, the fourth quarter effects is there here for all expenses, but it's by far most stark for cost of goods sold and SG&A, not so much for depreciation and special items. Also, when we look at it in terms of CFO, so cash flow from operations relative to accruals, for CFO, again, we see like a pretty stable effect across the size distribution, but for accruals, again, we see that the accrual earnings effect really drops for these smaller firms in the first quartile. And then if we break down the accruals, we also see that it's really driven here by these accounting estimates, right? So these accrual expense estimates, that really seems to be it. So the fourth quarter effect, just from this descriptive analysis so far, really seems to concentrate an accrual expense estimate for small firms, right? So that seems to be it. The next thing, of course, after describing it like that, is to think about what might be driving it, right? So what might cause this fourth quarter effect that we observe. First explanation that has been proposed by papers that have looked at similar stuff, again, not what we're looking at here, but at, similar patterns in the data, is auditor conservatism. So what is auditor conservatism? Well, in a nutshell, this encompasses this idea that auditors, tend to be more present at the firm in the fourth quarter relative to other quarters. In interim quarters, they just have to do a so-called audit review, whereas in the fourth quarter, so at the end of the fiscal year, they really have to come in and do a full-scale audit. So it then could be that auditors are very conservative, so they rather have firms reporting lower earnings rather than higher earnings, so that they are a bit shielded, right? So that they don't get as easily into situations where firms are overstating earnings, which might then come with a reputational loss, for example, for the auditor.
Question for... Yeah,
Hi.
Stella?
Hi, Ollie.
Oh,
Can I ask you something? Sorry,
Please,
links
please.
back to actually quite the beginning, right? I think the pattern is really interesting because we would rather expect spikes at the end to manage earnings upwards, or at least to align with own interest and incentives. So what I was missing a bit in your whole discussion so far, that you didn't talk at all about what are the incentives at the year end. And these, like, as I understand, right, these are only the fourth quarter on earnings. How does it map then to the total annual earnings? And do you explore something tied to managers' incentives, compensation or contracts and so on?
Yes, great question, Tanya. So that's what will be upcoming in the next potential explanation here. So like this earnings management explanation, right? But I think you also, so keep tuned for that. But I think you also asked a very important second question, and that is, how are our fourth quarter earnings here special just from a procedural perspective? And they are indeed special in that for most firms, not all of them, some report fourth quarter earnings or fourth quarter financial reports really on a quarterly basis. But the vast majority of firms does not explicitly report the fourth quarter. Instead, what they do is they just report the full fiscal year in the fourth quarter. And then, for example, providers like Compustat then just extrapolate to the fourth quarter because they already see the first, second, and third quarter. And so you can back out the fourth quarter report, so speaking, right? So in that, the fourth quarter is indeed special because many firms do not disclose it explicitly, right? So which makes it quite interesting. Yeah. So, but before we get to the earnings management explanation, just a couple of pointers here to the auditor conservatism explanation. Well, two things that do not appear to line that well in what we have seen already with that explanation is that on the one hand, we have that Larson paper that analyzed, okay, in which accounts is earnings manipulation or like earnings overstatement most common. And What Larson found in 2008, and I think that is still true today, is that, well, revenues tend to be the most manipulated account generally, which again, in this case here, kind of goes against the fourth quarter earnings effect because the revenue effect is actually positive, right? So, which is then inconsistent with auditor conservatism. Also, the fourth quarter effect is weakened for larger firms that would face more public scrutiny and where auditors would then have more of a risk of some reputation damage if the companies are reporting too aggressively. We also did an additional test. Of course, all of this stuff is very hard to test, and I want to be very upfront from the start here. I don't think we can really rule out any of these explanations that I will discuss now, definitely. But well, we try to triangulate and do our best and to kind of come to a conclusion at least which of those explanations most closely aligns with the patterns that we observe in the data. So one thing we did here with respect to the auditor conservatism explanation is we exploited a regulatory change in 2002 when firms had to now provide also a mandatory audit review for interim quarters in addition to the annual audit that they would have to provide at the fiscal year even before 2002. So the logic here is that if in the world before, if the auditor was just present in the fourth quarter, then all this conservatism would essentially concentrate in the fourth quarter. You know, all of this pressure from the auditor side would be exerted in the fourth quarter, that they would now recognize all these accrual expenses, and this negative effect then from these higher accrual expense estimates that would be pronounced relative to after, when the auditor is already there for the full fiscal year, and then some of that conservatism would be distributed across the other interim quarters. But this is the opposite of what we see here, right? So when we look at this, when we interact this auditor review, so essentially an indicator for after 2002, we actually see that the fourth quarter effect gets stronger after we have mandatory audit reviews, right? So opposite of what we would expect under the auditor conservatism story. And I think here we are now getting closer to what you were alluding to, Tanya, the earnings management explanation, right? So managers' compensation tends to be tied to reported earnings. So especially if earnings are tied to the fiscal year, then managers might be very incentivized to boost earnings in the fourth quarter to increase their bonus, right? So if we then look at it from this whole fiscal year perspective, then we would expect a negative effect. Of course, it could also be that their compensation might be tied to quarterly performance, which I think is less common, but it could be, right? So, and in that case, that would be more aligned with what we find, right? So that we then would see like these positive earnings effects during the interim quarters, when essentially some of these accrual expense estimates would not be in there and then somehow pushed to the fourth quarter. So that might be consistent with it. Again, we try to design a test to address it somewhat, right? So,
Oliver?
yeah, please.
Yeah, Hank, you have a question?
Oh, hey, Oliver. Hi,
Hey,
nice to
Sejong, long time no see.
Yeah, really interesting discovery. So I guess like my question is like there are certain maybe you will talk about this later, but like I guess feel free to defer. But my question is like, you know, there are certain things firms do only at the end of the fiscal year, right? Impairment, special items. So I think I've done some empirical work with banks. Yeah, I think what I see is for some banks they seem to take the loan loss provision only towards the fourth quarter. So I don't know, you know, to what extent this is capturing the impairment, those things people done once in a year, or like it's more about something in the fourth quarter. Thank you.
Yes. No, I mean that's like a absolutely correct observation, right? So for example, if you think also about goodwill impairments, firms have to test for a goodwill impairment in one of the 4 fiscal quarters, but they are free in designating which quarter they pick. Empirically, most of them pick the fourth quarter. So that's what we know. But interestingly, like when we looked at goodwill impairment data, we didn't really see anything in there. What we have seen, I think that is kind of aligned with what you were alluding to for banks, that they are then putting the loan loss provision estimates into the fourth quarter. I think this is aligned with the result that we briefly discussed here, right? So for example, with the inventory impairment, that inventory impairments tend to be quite a bit higher in the fourth quarter, and that bad debt expense, things like that, right? So might be higher in the fourth quarter, right? So which is kind of then aligned with this notion that a lot of these accrual expense estimates are being pushed to the fourth quarter. So I think what you are saying is very much in line with what we are alluding to here.
Yeah, thanks.
Thank you for the question.
Yeah, Sazan?
Thank you. Thanks, Oliver. Very nice presentation. One question I have, maybe also you have it on your agenda, but is there any surprise to that? So like, so do you have evidence that, for example, market with extra surprises by the fourth quarter results, or like analysts are not getting that, or something like that?
Yeah, give me a couple of slides. I will show you both. So that there indeed that markets react to the fourth quarter and then essentially very quickly reverse, whereas the same effect is not present for interim quarters. And we also see the same thing with analysts. So we see that analysts tend to be surprised on the negative side. And for those analysts for which we also have sales forecasts, we then can essentially see, okay, where is it coming from, this earnings surprise? Is it coming from analysts' forecasts of sales or analysts' forecasts of expenses? And we see that it's entirely driven by the expense side. So indeed, analysts and investors do not fully seem to account for this.
Thanks.
Thank you very much for the question. I'll show you that in a couple of slides. First, just talking a bit here about the earnings management explanation. Again, we are not able to fully rule this one out. The one thing that we're thinking of is just to look at what are the most commonly used measures of earnings management. First, with the most simple model that was pushed by the De Chao et al. Paper, and then, of course, like its later developments with the Kothari performance matched accruals paper. And so here we look at, okay, is the effect pronounced for firms that, according to these standard earnings management measures, are more prone to earnings management? And what we find actually is that the effect is much stronger for firms that are less prone to earnings management, right? So where we see these discretionary accruals to be below sample quarter median, right? So and the difference here is significant at more than the 1% level, right? So across all these different models. So again, we cannot rule it out, but at least the smell tests do not really seem to be that well aligned with the earnings management story. Another story is this integral reporting story, right? So that there are just certain linkages between quarters that then lead managers to correct interim estimates in the fourth quarter, right? So that you are then essentially allowed to push things like bad debt expense to the fourth quarter. And that is then something that is actually allowed under integral reporting. The question then is, of course, why always the fourth quarter? Why not push it into one of the other quarters? And another question is then, of course, well, if it's all about this integral reporting, that I have to see the fiscal quarters as part of a fiscal year, and it doesn't matter so much where in the fiscal year I put it, but I just have to put it somewhere. Well, then it should not really be the case for companies that have to report in accordance with discrete reporting, right? So one of the differences between US GAAP and IFRS, for example, is that under US GAAP, firms are allowed to use integral reporting, whereas, I mean, they actually have to, but whereas under IFRS, they have to use discrete reporting. That is, they have to essentially regard every single reporting period as on a standalone basis, rather than seeing them as part of a full fiscal year. So swapping or pushing expenses around as you might be allowed to under integral reporting would not be allowed to. We would not be allowed under discrete reporting. And here again, we did some smell tests, essentially, some smell checks. So first we just start with looking at US companies, and this is the fourth quarter effect that we have observed, and then we constrain the sample into firms where we can observe that they are reporting under US GAAP, where that's clearly disclosed. Then we are also looking at firms listed in the United States that are actually reporting under IFRS, right? So these are essentially American deposit repositories, right? So large firms that are headquartered in other countries than the United States that are listed in the United States to access the United States capital markets. But importantly, these firms do not have to follow US GAAP, right? So I think since 2012, if I remember correctly, the SEC actually allows these ADRs to just report in accordance with IFRS. So they do not have to reconcile to US GAAP anymore. And what we see here is that the fourth quarter effect actually gets quite a bit stronger for these ADRs, right? So for firms that use discrete reporting, so like rather than integral reporting, so firms that look at every quarter on a standalone basis, well, we see that the effect is there and in magnitude actually quite a bit higher than under US GAAP. Another interesting pattern we were trying to exploit is to look at Canadian firms, because before 2011, Canada was using Canadian GAAP, which essentially was also demanding an integral reporting approach. Whereas after 2011, Canada now started to use IFRS, where they then moved to the discrete reporting approach, right? And what we see here, when we just look at Canadian firms before and after 2011, we see that the fourth quarter effect is there in both subsample periods, right? So this differentiation that is just driven by integral reporting, that doesn't seem to be the case. Another thing we have done, which we left untabulated for now, is we have also looked at European firms and UK firms, where sometimes they use, of course, also quarterly reporting, but sometimes also semi-annual reporting. And we see something very similar even for semi-annual reporting, that when you just have, well, 2 periods in the fiscal year, well, systematically, earnings in the second period of the fiscal year tend to be quite a bit lower, right? So this doesn't seem to be anything that is just concentrated in like quarterly reporting or in jurisdictions where integral reporting is the way to go. Then we also test the fourth explanation, and that is the explanation that at this stage, we believe seems to be the most plausible explanation, and that seems to be most aligned with all the empirical facts that we were able to observe so far. And that is the internal information quality story. In a nutshell, well, it could be that firms just do not invest as much resources into producing financial statements for interim quarters relative to the fourth quarter, right? So it could be that firms are, especially when it comes to these accrual expense estimates, well, that they take a bit of a lax approach in interim quarters, but then at the end of the fiscal year, when there's much more attention to the annual reports, that and the auditor is now in-house essentially, that then just more resources and more attention is now being devoted on getting these accrual expense estimates right? Because again, remember, that's where it all concentrates in. So we did a couple of tests to explore this, and we believe a nice, relatively direct way to look at that is to look at, okay, what resources are firms spending on their internal information systems. And so what we did here is we used value data to look at the percentage of the employees in the company that are working and controlling, right? So the people that are responsible for coming up with these accrual expense estimates. And we see that the fourth quarter effect is much stronger for companies that have a relatively low share of employees that work in controlling. We also looked at the wage part. Here we have to be a bit careful because Revalue estimates those wages. They do not observe those wages. There are some papers that essentially argue that those estimates by Revalue are quite good. So that this is something that more and more people are using, but just a caveat for you to be aware of. When we look at the percentage of the overall wages paid in a company here, as reported by Revalue, we also see that the effect is very heavily concentrated and firms that, let's say, pay their controllers relatively less, right? So that's kind of the takeaway here. So again, these two analyses here kind of indicate that the effect is stronger for firms that invest relatively less into producing accrual expense estimates, one of the major jobs that controllers have within an organization. We also looked at less direct proxies, and this is, I would say, the current state of the art. That is Eva's and John's paper in 2015 in the Journal of Accounting and Economics, where they came up with internal information system quality proxies. In particular, they looked at the ones here. They looked at the absolute management forecast error. The intuition here is, well, the higher management forecast error, well, the lower quality the internal information system seems to be. And so we find here is that the effect is quite a bit stronger for firms that have, well, higher management forecast errors, again, indicating that those firms have lower quality internal information systems, and the fourth quarter effect is stronger for them. Another proxy that they are proposing is the reporting lag. That is, how many days does it take a firm relative from the end of their fiscal period to the date when they're reporting earnings, essentially. And here again, the intuition is the longer it takes them, well, the lower the internal information system quality. And again, we find here that for those firms that have a very high reporting lag, so those firms that take a very long time between their fiscal period end and the time when they're reporting their financial results, so the effect is very much concentrated on those firms. And lastly, there's of course also data from audit analytics on internal control weaknesses. So this is probably a very direct proxy actually of internal control, like low internal control system quality, right? So, and again, we see that the effect is much stronger for firms that at some point report internal control weaknesses, right? So again, consistent with this explanation or the story, that those firms that have relatively weaker internal control or internal accounting systems, that the effect is stronger for those. The question, of course, and that is Saslan's question that he asked earlier, right? Like, does it matter, right? Like, or is that something we can just disregard? And the natural way to answer this question is to look at people that, well, rely on these data for a living, right? And, well, who are these people? Well, the two common groups that we look at are analysts and investors. The first group we look at here are analysts. And so we look at whether analysts are systematically more surprised, or in particular more negatively surprised, in the fourth quarter relative to other quarters. And if we just look at it unconditionally, we see that's the case. We also split this up into positive surprises and negative earnings surprises. And what we see here is that this effect that we observe for the overall earnings surprise is entirely concentrated in negative earnings surprises, right? So analysts are really negatively surprised in the fourth quarter on the downside. We also then, again, exploited like a smaller sample here of analysts for whom we also have sales forecasts. And so we looked at analysts again. Now in the smaller sample, we replicate the effect before. Do we see this negative earnings surprise effect in the fourth quarter? We do. And where is it coming from? Is it coming from the sales forecast or the expense forecast? That is what we can back out from knowing earnings forecasts and sales forecasts. And again, here we see that the effect entirely derives from the expense side of things. So analysts systematically underestimate expenses in the fourth quarter relative to other quarters. The next group that might be affected by this, of course, is investors, right? And so here we looked at return patterns, stock return patterns around the fourth quarter. And what we see here, when we look at these negative earnings surprises that I talked about before, we see a negative reaction in the fourth quarter, but also for interim quarters. However, the reaction is weaker for firms in the fourth quarter, right? So indicating that maybe investors get a bit of it, but they're still reacting, so they don't get it fully. Importantly here, when we look at it over time, what we see is that, well, the effect completely reverses within 60 days for the fourth quarter, whereas it remains throughout this entire period if we look at interim quarters, right? So indicating that this information that was being provided here, well, becomes to markets relatively clear even after like 60 days that it's maybe not that much information. It might just be like some misestimation that is going on here. We also look at that same test for positive earnings surprises, just to make sure, okay, that it's not there, right? And here we see what is finding, I think, that is relatively well established in the literature, which essentially indicates that after we observe positive earnings, well, returns tend to drift upwards even after that, right? So this is this post-earnings announcement drift pattern on the positive side. We also check a trading strategy to see, okay, can we form portfolios based on these patterns and essentially profit from it. So what we do here is essentially we look at, well, first of all earning surprises, and then we go short into firms that will now report the fourth quarter, and long on firms that will report in other quarters. We already see that we get highly significant, these are 5-factor alphas here. This also works for just returns or other factor models, but this is kind of the standard right now, so we want to display that here. And we see that we are already able to generate some alpha by choosing the strategy. But if we break this down again into positive and negative earnings surprises, we really see where it's coming from. It's all coming from these negative earnings surprises, right? So that then allows us to make these trading profits. Again, consistent with this notion that there are these accrual expense estimates that then lead people to be negatively surprised in the fourth quarter, but that then within a very short amount of time already reverse. Where within a relatively short amount of time, people already figure out that this might not be that valuable of fundamental information, such that the trading reaction reverses very quickly. So just to conclude here, earnings are systematically lower in the fourth quarter. We are, to the best of our knowledge, the first to document that systematically and to explore this. How do we explore it? Well, we show that the effect persists after holding economic reality constant, right? So even if we look at within a given industry year, and that the effect persists across time and across the entire earnings distribution, it very heavily derives from accrual expense estimates, which just seem to be much higher in the fourth quarter relative to other quarters, and it's much stronger for smaller firms. We looked at a bunch of explanations. We don't find that the auditor conservatism, the earnings management, and the integral reporting story align that well with these patterns and some additional results that we have provided, whereas this low internal information system quality seems to align very well with all the facts that we present in the paper. The effect also seems to be consequential. On the one hand, analysts systematically underestimate fourth quarter expenses. And if we form trading reactions based on that, we see that the stock market reaction is quite a bit weaker in the fourth quarter and reverses quickly. And so these trading strategies that we design based on it, well, they yield abnormal returns then. And that's essentially our paper. Thank you very much for your attention. Any questions, comments that you might still have for us would be very much appreciated.
Yes, thank you very much, dear Professor Oliver. Thank you very much for your contribution and your effort. It's really an excellent presentation, excellent paper. Now, if anyone have any questions, you can open your mic and ask your question. Tana?
Yes, I had a question when you talked about the analyst and stock market reactions. So if they underestimate expenses, is that good for the firm, or how can I see that? Because what I was wondering, it was interesting what you said is that some firms disclose fourth quarter earnings specifically, and some just bundled with the annual earnings, and whether you see value in digging deeper into that, like who discloses that and what are then advantages or disadvantages?
Yeah, so like whether it's good for the firm that analysts kind of underestimate expenses. Yeah, I mean, like
I mean, accuracy goes down, right? So
Accuracy
they're less
goes down.
accurate, but
So if I'm
expensive,
interested,
like it's a higher forecast potentially. No, I just wonder, and then how that would interact to firms' own fourth quarter earning disclosure decision. I think that would be interesting for me.
yeah, I know that's a great question. Like from the perspective of a firm that just wants to convey economic reality, then it's of course not good because that indicates that people are systematically off here. From the perspective of a firm that wants to report a positive earnings surprise in the fourth quarter, it's also not good because, well, then those accrual expenses tend to be higher than anticipated, so it will be harder for me to surprise positively. Right. So, but it could be that maybe firms, for some reason, want analysts to be like, I'm not sure why they would want to disappoint on the downside. Again, like one explanation, which would be the kind of this earnings management explanation, is that firms might want to surprise on the upside in the interim quarters, and then the fourth quarter that will kind of go under for the full fiscal year. So maybe they believe that it's then not so important for whatever reason. And as a result, that might be good for them because then they could essentially use the fourth quarter to camouflage things. With this idea to then split into firms that are disclosing the fourth quarter separately, that's a very interesting idea. We would love to do that. We've looked into a lot of these reports, and so far I have seen exactly one where this was separately disclosed. So it's something we can look at in more detail. But my hunch right now is that it's not very common.
So
If I may, it's yeah, I mean the results on analysts was also interesting. I think your explanation is somehow correct, so that these people are suffering from less talents in the accounting groups. But I think the same is also true with the analysts. So I think the talent among analysts are also not distributed equally in the economy. So that could be that these firms are more populated by non-star analysts or lower quality analysts. And I don't know if it is also in line with your story to explore that or not, but could be also an angle.
That's true. That's also what I would suspect here, right? So if you just think about the size result, we see that the effect is much stronger for smaller firms. Smaller firms tend to have also lower analyst coverage, right? So like again, they're like in general getting much less public scrutiny. So we will check, but I mean I would be very surprised if we wouldn't find this result.
Are there other questions? If anyone have any questions, you can open your mic and ask your question.
Hi,
I
Ollie.
do.
Maybe. Hi. Oh, Edith, go ahead.
All right, thank you. Thank you so much, Oliver, for this seminar. So my question is in relation to stock trading. How do we align this together for someone who is looking to invest, okay, in stock and looking at the impact of fourth quarters, earning effect? Will it be a good time for such an individual or such an investor to, dive into the market?
Yeah, so what we have, so let me go to this. So how we designed what I showed you here is we look at a given point in time. We look at the cross-section of firms, so for the first column, and then we essentially sell stocks that will now report, shortly, will shortly report their fourth quarter earnings. So we will short those, and we will go and we will buy stocks of firms that will report their interim quarter, like Q1, Q2, Q3. So it's like a pretty easy to implement strategy here. In columns 2 and 3, it gets a bit more involved, right? So we always, so the portfolio is always formed after we observed the the earnings announcement. And here we go then short into firms that observe. So we go short on firms that report in the fourth quarter, long on firms that report in the non-fourth quarter. So you see a negative earnings reaction. So you observe that at the earnings announcement. And then depending on whether it's Q4, Q3, you buy or sell those stocks, right? So it's pretty straightforward to implement, I would say. Thank you very much for the question, Edith.
Thank you.
Sanjay?
Yes. So there seems to be, hi, Ollie, there seems to be some response on the analysts' results. And I wonder if you looked more into the analyst incentives. So do you see that firms that easily meet or beat are more likely to have low fourth quarter where it doesn't make them, not meet or beat the analyst forecast? Or do you see that there is less of a walk down for these firms? Have you? I assume you've looked into that.
We have not, but that's also a great idea. So it's like something we could do, right? So, like kind of look at. So essentially, kind of look at firms whether the fourth quarter effect is stronger for firms that just report like a small earnings increase, or is that kind of the intuition? Kind of.
Yeah. So you in your bullet you say analysts are systematically surprised, and you would expect them to learn from this unless there is some understanding there, right? So the walk down, right? So yeah, maybe that's some direction you could go into to focus also on the analyst incentives. So I think maybe in terms of thinking about why this is happening, what are the incentives in play? There seems to be a lot of responses on the analyst explanation here. And perhaps that would be interesting. Yeah, you would expect that you're not going to have lower fourth quarter earnings if it causes you to miss suddenly, perhaps if you find some results in the direction. Or, there is less or more of a walk down by managers in certain situations when, you don't have to walk it down, or you don't walk it down and you actually want to have those costs in this quarter.
Yeah.
Perhaps even look at like merger between brokers houses where some of the incentives disappear. Just some thoughts that I had based on your bullet, that it's systematic, and you wouldn't expect that as an analyst. You would expect, they also have their loss function. You don't want to always be wrong. So there must be something there potentially. So that would be the thing that I was thinking about based on your bullet.
Yeah, no, it's a great point. Thanks so much, Sanjay. Like we'll think more about it. I cannot give you, I think, like a good answer right now, because I have to again think it a bit through, because like if I think about, okay, now I identify, for example, when we think about the just beat benchmark, right? So someone that just like beats like the zero benchmark or an analyst forecast, then that is an indication of earnings management. And for those, then like, I guess like the intuition here is that managers would actually use accrual expense estimates to just make that benchmark, right? So it would kind of go the other way around of what we are
Exactly. So that
showing
would be
here.
surprising, right? That you would do that as a manager. That would be surprising.
So we have to think more about this. Like right now, I'm not entirely sure how to respond. So
Sure.
we'll look into it and dig deeper there.
Okay, thank you.
Thank you.
Are there other questions? If anyone have any questions, you can open your mic and ask your questions. Professor Oliver, I'm wondering if it will be useful to consider the quasi-experimental design difference to address the endogeneity. What do you think about this?
Yeah, of course. So I'd love to get a natural experiment here, right? So the question then is like the question that we then were facing, right? Like what is our exogenous treatment here, right? So, and what is the regulatory change that then would drive this, right? And I guess that would depend on the explanation, right? So like we could use like a difference in difference design here to somehow get an exogenous increase in internal information system quality, where we then would be able to split firms into a treatment and control group. Maybe there's something with Sarbanes-Oxley that might be doable there, but then of course everyone is treated at the same time. That makes it a bit difficult. An alternative option would be the EU directive in 2013. That might be something we could do there again to kind of address the internal information system quality story, right? So if we want to kind of provide a bit more tightly identified evidence there, that's definitely something we could do, right? So and similarly, like there might be settings that we could also think about for the other three, right? So like one nice one we were hoping to be able to exploit was the audit reviews. The tricky thing then is, of course, again, everyone is treated at the same time, right? So we just don't have a treatment and control group there. But maybe in Europe we can get a bit more traction on differentiating. Thank you.
Thank you. Michael?
Yes. Hi, Oliver. Good
Hi,
to see
Michael.
you.
Good to see you.
Yes. So I just have a quick thought. I wonder to what extent the pattern that you document is driven by fundamental as opposed to the reporting process. One idea is, I don't know if you have checked across industry variations. Maybe certain industries are more seasonal, has more seasonality than others. See if you can document correlation with that industry. The other idea is to see if there's any company have changed their fiscal year end, thereby changing the fourth quarter from one calendar month to another calendar month. Ideally, that's not going to change their fundamental patterns, but it obviously changes the reporting pattern. So hopefully that can give you some idea.
Yeah, no, thanks. Great suggestion, Michael. So we've done both. So the effect is there pretty much for every industry. It's quite pervasive. With respect to this firms changing their fiscal quarter ends, what we've done there is we have put in firm month fixed effects, essentially, right? So then we would just look at, okay, how does the effect change for a given firm in a given month of a fiscal year, but now it's the third quarter rather than the fourth quarter. And we still see the effect. So it's still there. Like right now we just put it in a footnote because we were a bit struggling with what to do with it, because the decision to change the timing of your quarter end is also endogenous, right? So and so in terms of just in the spirit of trying to provide causal evidence here, like we were kind of struggling a bit with that, because on the one hand we have firms that do not change this the fiscal quarter end, right? So if that's like a long-standing policy, that's like relatively exogenous, right? Of course, like at the beginning of the life of the firm, at some point they picked like, okay, we end our fourth quarter in September or December or whatever, and then they just stuck to it, but it's probably not so related to current economic conditions. So another thing we had done is we have just focused on firms that keep it steady, so that always just keep the quarter ends in the same month, and we also see the effect there. But we also did the same for the switchers, right? And like I agree, it's quite interesting that you can even see the effect even for the same firm within the same calendar month, but now you just have your third quarter rather than your fourth quarter. But again, like in terms of identification, like we have been struggling a bit with what to make out of it, because the decision to switch when you end your quarter is endogenous and might respond to current economic conditions of the firm.
Okay.
Thank you very much for the question.
Sanjay?
Yeah, just I was just wondering, have you looked at if the CFO has an audit background?
We have not. We have not. But that's like
Okay.
certainly something we'll check, right? So it kind of goes in the spirit of this test here, right? So it's like
Yes.
another,
Yeah.
it's another test to kind of say, okay, CFO has more accounting expertise,
Yes.
and as a result, they might be better at making accrual expense estimates, so the effect should be weaker.
Yeah.
So yeah, certainly something we can check.
And then maybe some change in CFOs or something like that. Great.
Yeah, great idea. Thanks, Sanjay.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Oliver, for your contribution and your effort. Thank you, everyone, join us today, and thank you very much for taking the time to present to us today. It's been appreciated, dear Professor Oliver.
Thank you very much for organizing, Mohamed, and thanks for everyone. Thanks to everyone for coming and all those wonderful suggestions and comments. We very much appreciate it, and it will make the paper quite a bit better. Thank you for taking the time.
Yeah, and I hope to see you soon in Egypt. You are very, very welcome.
I would love that. I would love that.
Yeah.